I said we would have a run on the bank. Maybe not physically people running to the bank, but through the internet, electronically, the small investors or the small depositors, right? They would have left their money there because they're under the 250. But all the big depositors were going to yank their money out of all these small banks, and they were going to put it in the too big to fail banks because after all, they're too big to fail. So no matter what happens, the government won't let them fail. So the deposit insurance doesn't even come into play because if the bank can't fail, well then, the government's got your back, which is a huge problem. But I think a lot of people would have seen this bank, and especially with the Signature Bank, a second bank, going under over the same weekend, people would have been very scared and they would have rushed to pull their money out of those banks, other banks, and the whole system would have toppled like a bunch of dominoes. And so they decided to stave off that run by assuring everybody that there was not going to be, that all the deposits were going to be covered. Oh, and by the way, even before I move on to that topic, the idea that the shareholders and the bank executives weren't bailed out. Oh, yes, they were. Maybe they weren't bailed out for these two banks, for Silicon Valley or Signature, but many more banks were going to fail had the Federal Reserve not backstopped them. So those executives were bailed out because they would have lost their jobs when their banks went under, but now their banks are not going to go under because of the bailout. A lot of stockholders would have lost their money, but now they're not going to lose their money because of these bailouts. Yes, there's a couple of people that got punished, but all these other banking executives who made the same mistakes, who have the same over-leveraged balance sheet, loaded up mortgage-backed securities, treasuries, 10, 20, 30-year maturities with 1 to 2% yields, they all bought up. They all did this. And so now they're all going to get bailed out. You had a couple of sacrificial lambs that went to the slaughter, but now everybody else is getting bailed out. So this is a massive bailout. But the point, again, that I was just trying to make is they wanted to stop the runs. And so they guaranteed all the bank deposits. And that led President Biden, to come out and say that, oh, the banking system is now sound. Don't worry about anything. You don't have to take your money out of the bank. My administration, we were Johnny on the spot. We worked real hard over the weekend to solve this. And, in fact, one of the things I thought was funny is that Biden says that, we're going to find the people responsible and we're going to punish these people and hold them accountable. Well, you don't have to look that far because one of them is in your administration. She's the Secretary of the Treasury, Janet Yellen. The people responsible for this mess are all the chairmen and chair ladies of the Federal Reserve, starting with Alan Greenspan right up to Powell. And of course, a lot of other people in the government and the administration are the ones to blame. But Biden claims that what they did has made the bank deposit safe. No, as a result of these bailouts, the money that people have on deposit at banks is at greater risk than ever. In fact, it's not just the deposits of these failed banks, but every deposit in every bank is now at risk. And the reason is because of inflation. Massive inflation is going to be created to pay for these bailouts, a return to quantitative easing. Prices are going through the roof. That means the purchasing power of bank deposits is going to fall through the floor. And so there's more incentive now than ever before to rush to the bank and withdraw your money before inflation destroys it, and then buy gold, buy silver, or buy some inflation hedge. But the worst thing you can do is leave your money in the bank. Let me explain how this bailout is going to work. So what the Federal Reserve is going to do, any bank, not just, these couple of banks, but any bank now can go to the Federal Reserve and swap their underwater paper for cash at face value. So let's say you were dumb enough, and pretty much all these banks were dumb enough to do this. And of course, I was warning for years that nobody should buy bonds. It was a massive bubble The bond market bubble was even bigger than the stock market bubble. Yet these banks were buying all of these bonds. And, by the way, a lot of people are now being critical of Silicon Valley Bank for being dumb enough to buy long-term treasuries or mortgage-backed securities. But it's completely disingenuous for anyone in the government to be critical. It's one thing for me to criticize them. I got a right to criticize them. Remember, my bank didn't buy any of this crap, right? My bank was totally solvent. My bank could have survived a run. Every one of my customers could have asked for their money back, before the government put it into receivership. Any one of my bank's customers could have got their money back on the same day. We could have handled a 100% run because we had no loans, we had no debt. Interestingly, of course, when they shut down my bank, they held a big press conference to make a big deal. None of these banks that they shut down, they didn't hold any press conferences. They just shut them down. But, with my bank, we have to have a press conference to pretend it's insolvent, even though it's not. And then we can have the IRS there talking about money laundering and tax evasion, which has got nothing to do with this bank because it was just investigated for money laundering and tax evasion, and it was exonerated. After a 2-year investigation, they found absolutely nothing. But anyway, I digress. I don't want to get back, but I noticed people putting in these comments about how I have experience, with banks being seized and banks being shut down, because of my own experience, but it's completely different. I didn't do anything wrong, and of course, I'm not getting bailed out, and neither are any of the bank customers. Not that they even needed a bailout, but unfortunately, they still haven't been able to retrieve their money, even though every penny of it is sitting there. But in any event, getting back to how this bailout is going to work, the reason that the government can't criticize Silicon Valley Bank and their judgment to buy these bonds at the peak of a bubble, the government encouraged them to do it. First of all, the Federal Reserve kept short-term interest rates at zero, so the banks couldn't earn a return on their deposits. So in order to get a return, they had to go way out on the risk curve and buy these long-term bonds to get any kind of yield. Now, they should have just passed, but they really had no choice since they don't really think about the long run, thanks to all the disincentives that the government has put into the system. They just live for the here and now, and so they just bought those bonds and didn't worry about what might happen when interest rates would eventually rise. Maybe they just thought that they never would. They just made that assumption, and they were wrong. But it's not just the Fed. The way the government accounting rules work, they encourage banks to hold U.S. Treasuries and mortgage-backed securities. One reason is because there's no haircut. So if they had bought other types of securities, private securities, they would have to take a haircut. Maybe if they had $1 worth of a private security, they'd have to take a 10 or 20% haircut. And it would only be qualify as 80 cents. The Treasuries and the mortgage-backed securities were 100 cents, no haircut at all. And so the banks had that incentive to buy treasuries and mortgage-backed securities versus other assets or making loans where they would have some type of haircut on their capital. Also, they didn't have to mark this stuff to market. So it didn't matter if the bonds went down, as long as they qualified them as hold to maturity, which they were able to do at their own discretion. Well, they don't have to market, which is a fraud, because the market could collapse and these banks are holding huge losses, which is the case. So here's the way this bailout works. So let's say I'm a bank and I was dumb enough to follow the government's advice, and I loaded up on a bunch of 10 to 30-year treasuries and mortgage-backed securities, and they're yielding 1%. And now some of my depositors want their money back because they could take it to a money market and get 4.5% or 5%. Why are they going to leave their cash there at 1%? Or maybe they just need their money. Their business is having a tough time in this recession that no one wants to acknowledge. And so people start going to the bank and they want their money. Well, the bank doesn't have it because it's tied up in these bonds. And let's say they bought the bonds at par, and now if they sold them, they'd only get 70 cents. So they're sitting on huge losses. Well, instead of failing like Silicon Valley Bank did, because they had to sell that paper into the real market and get a real price, what the bank could do is now go over to the Federal Reserve and say, hey, here are these bonds. They're only worth 70 cents, but the face value is $1, right? That's what they mature at in 10 years. And you can take those bonds and give them to the Federal Reserve. And the Federal Reserve will give you 100 cents on the dollar right now. You don't have to wait 10 years. You get the cash right now. But you're getting a lot more than those bonds are worth. Now you can take that cash and you can return it to your customers. So you didn't have to sell. You got the full value of the bonds. You didn't lose anything. Now, of course, eventually you're supposedly going to have to get that bond back from